In the intricate landscape of finance and life, few names carry the esteem, respect, and curiosity earned by Warren Buffett. Known as the Oracle of Omaha, Buffett's impact extends far beyond stock markets. His approach to smart investing and living simply has become a guiding beacon for millions seeking clarity and purpose amidst the complexities of wealth and life's choices. This book, How to Think Like Warren Buffett, Secrets of Smart Investing and Simple Living, invites readers into the world of Buffett's enduring philosophies, gleaning lessons not merely for financial growth, but for a life led with intention, generosity, and wisdom. Buffett's journey is a testament to the power of discipline, patience, and the relentless pursuit of knowledge. He built Berkshire Hathaway not as a monument to personal success, but as a living embodiment of value, investing's principles, resilience in adversity, and thoughtful stewardship. His strategies, distilled through decades of measured risks, failures, and triumphant recoveries, illuminate the pathway for investors and life architects alike. Yet, Buffett's legacy is not confined to his remarkable portfolio. It is equally woven into the ethos of simplicity, living modestly, investing deliberately, and fostering a culture of giving. These values demystify the supposed correlation between wealth and extravagance, highlighting instead the importance of clarity, humility, and philanthropy within one's pursuits. His life demonstrates that wealth, when nurtured through wisdom and shared generously, becomes a tool for enrichment, both personal and communal. Chapter 1. The Buffett Mindset, Thinking Long-Term. Warren Buffett's investment philosophy is defined by his unwavering long-term perspective. In a financial world obsessed with short-term gains, quarterly earnings, and the relentless fluctuations of the stock ticker, Buffett stands as a beacon of patience and foresight. The Buffett mindset is not merely about holding stocks for years. It is about adopting a holistic view that considers the future in every decision made today. To understand the power of long-term thinking, it is essential to first recognize the pervasive nature of short-termism in investing. Market participants, driven by the urge to outperform benchmarks and realize quick profits, often undermine their own financial prospects. This phenomenon, fueled by emotional reactions to news, trends, and rumors, results in frequent trading, high transaction costs, and suboptimal investment results. Buffett's approach, in stark contrast, is grounded in the conviction that patience breeds prosperity. For Buffett, investing is about acquiring a piece of a business with the intention of holding it for the long haul. He likens the stock market to a voting machine in the short run, but a weighing machine in the long run. This distinction reflects his belief that although prices may be influenced by popularity and sentiment in the short term, over time, intrinsic value prevails. Market volatility may provide buying opportunities, but it should never dictate the sale of quality holdings acquired at fair prices. The roots of Buffett's long-term perspective can be traced to his deep understanding of compound interest. He has often stated that the eighth wonder of the world is compound interest, an observation which applies not only to investments, but to knowledge and relationships as well. By allowing investments to grow uninterrupted over many years, Buffett has harnessed the exponential power of compounding in unprecedented ways. For example, his early investments in companies like Coca-Cola and American Express have been held for decades, yielding returns that would be impossible to match by frequent trading. Emotional discipline is a core element of the Buffett mindset. Markets, by their nature, will undergo periods of exuberance and despair. The true test of a long-term investor lies in the ability to remain detached from crowd psychology, making calm decisions when others panic. Buffett's reminders, "Be fearful when others are greedy and greedy when others are fearful," are not just clever sayings, but central tenets of his investment practice. Buffett's success also draws from his refusal to be swayed by market timing, a notoriously difficult endeavor even for the most seasoned professionals. Rather than attempting to predict when markets will rise or fall, he focuses on investing in great businesses at attractive valuations and letting time work its magic. This patience is exemplified by his famously infrequent trading activity. His preferred holding period, as he often quips, is forever. The Buffett mindset extends beyond investing. In managing his business conglomerate, Berkshire Hathaway, Buffett has shown the same commitment to playing the long game. He chooses managers and partners with great care, seeking those who share his principles of integrity, frugality, and long-term vision. This philosophy fosters an environment where businesses are built to last, and decisions are made with the next generation in mind. Another dimension of the long-term outlook is the acknowledgement of mistakes and the willingness to learn from them. Buffett is transparent about his errors, seeing them as invaluable sources of education that sharpen his judgment over time. This humility and openness to self-improvement are key differentiators between transient success and enduring greatness. In practice, adopting the Buffett mindset means aligning your thinking and actions with the future you wish to create. It is about resisting the temptation to chase fads or respond to every market movement, and instead committing to a disciplined, patient approach. Whether investing, building a business, or cultivating relationships, the lessons of long-term thinking are clear. Time is both your ally and the ultimate determinant of success. By embracing the Buffett mindset, investors can navigate uncertainty with confidence, capitalize on opportunities that others overlook, and build wealth that stands the test of time. In a fast-paced world, choosing to think long-term is not only a strategy, it is a profound statement of intent, echoing the values and vision of one of history's greatest investors. Chapter 2: Early Lessons. From Omaha to Opportunity. Warren Buffett's life and success are inextricably tied to his roots in Omaha, Nebraska, a place far removed from the financial epicenters of Wall Street or London. The narrative of Buffett's formative years is a testament to the power of environment, upbringing, and early choices in shaping one's destiny. Understanding this journey from Omaha to opportunity reveals the foundational lessons that underpin his later triumphs in investing and life. Born in 1930, Buffett displayed an early fascination with numbers and business. By the age of 6, he was already selling chewing gum and Coca-Cola door to door, laying the groundwork for both a relentless work ethic and a keen sense of value. These early ventures were not just means to earn pocket change. They were opportunities to observe human behavior, evaluate what products sold best, and understand the importance of profit margins. Each experience was meticulously logged in Buffett's mind, sowing the seeds of future business endeavors. Buffett's family played a pivotal role in nurturing his curiosity. His father, Howard Buffett, was a stockbroker and later a U.S. congressman. Howard's emphasis on integrity, self-reliance, and fiscal prudence left a lasting impression on young Warren. The ethos of living below one's means and viewing money as a tool, not an end in itself, was ingrained from an early age. This philosophy would become a cornerstone of Buffett's later thinking, distinguishing him from many of his more ostentatious peers. Omaha itself contributed to Buffett's worldview. Far from the distractions and competitive pressures of financial capitals, the slower pace and community-oriented culture of Omaha encouraged thoughtful reflection and independent thinking. Buffett was able to cultivate a perspective free from the herd mentality so prevalent in crowded markets. This independence, both intellectual and geographic, provided a lasting competitive edge, allowing Buffett to observe the market from a necessary distance and avoid the emotional contagion that can grip metropolitan investors. Buffett's appetite for learning was insatiable. He devoured books on business, investing, and statistics, At age 11, he made his first stock purchase, 3 shares of City Service Preferred for himself and his sister. The experience was formative. The stock dropped soon after purchase, only to recover later. When Buffett sold for a modest profit, he soon realized, watching the price soar further, that patience could have yielded far greater returns. This early misstep imparted lessons about market volatility, emotional reactions, and the value of holding great companies over time. Buffett's first real taste of opportunity came through compound learning and earning. He launched ventures such as pinball machines in barbershops and newspaper delivery routes, often reinvesting profits into new enterprises. Each venture compounded not just his earnings, but his experience and insight. By his late teens, Buffett had already amassed a significant savings, proof of the power of discipline and gradual accumulation. A pivotal moment came when Buffett discovered Benjamin Graham's classic, The Intelligent Investor. The principles within would later serve as the theoretical backbone of his entire investment philosophy. The concept of intrinsic value and the importance of a margin of safety became the guiding lights by which Buffett would evaluate every opportunity. Transitioning from Omaha to broader horizons, Buffett attended the Wharton School of the University of Pennsylvania, then transferred to the University of Nebraska. He later studied at Columbia Business School specifically to learn under Benjamin Graham. Despite his academic success, the lessons from Omaha, frugality, patience, integrity, and independent thought remained foremost in his mind. Buffett's early lessons reinforced the notion that success is not solely the result of intellect or opportunity, but of character forged in the everyday moments and choices of youth. He has often said that the habits you develop when young are the ones you will live with forever. The environment that shaped Buffett gave rise to a set of disciplines and values that became his ultimate competitive advantage. In considering these early years, the greatest takeaway is that opportunity is everywhere for those prepared to seek it, recognize it, and act upon it. Omaha may be thousands of miles from Wall Street, but for Warren Buffett, it was the center of the universe, a proving ground for the mindset and habits that would one day change the world of finance. Chapter 3: The Influence of Benjamin Graham, Value Investing Defined. The trajectory of Warren Buffett's investment career changed dramatically when he encountered the teachings of Benjamin Graham. Often hailed as the father of value investing, Graham's influence on Buffett cannot be overstated. It provided the theoretical framework and methodological rigor that would define Buffett's approach for decades to come. Understanding Graham's philosophy is vital to appreciating both the evolution and enduring essence of Buffett's investing style. Benjamin Graham's key insight was deceptively simple. Stocks are not mere pieces of paper or symbols on a screen. They are partial ownership stakes in real businesses. Investors, Graham argued, should approach the market with this mindset, grounding their decisions in the fundamental value of the underlying company, its assets, earnings, and future prospects. This was a sharp contrast to the rampant speculation and trading frenzy that characterized much of Wall Street. Both then and now, Buffett has described reading Graham's seminal work, The Intelligent Investor, as one of the luckiest moments in my life. The book's central tenets, margin of safety, intrinsic value, and Mr. Market, resonated with Buffett's practical experience and common sense. The margin of safety principle, the idea of buying securities at a significant discount to their intrinsic value, greatly appealed to Buffett's aversion to risk, while the Mr. Market metaphor helped him understand the folly of emotional decision-making. As a student at Columbia Business School, Buffett studied directly under Graham and would later work for his mentor at Graham Newman Corporation. There, he was immersed in the discipline of meticulous analysis, scouring financial statements, evaluating management, and calculating conservative estimates of a company's true worth. Graham's method was systematic and rules-based, relying heavily on quantitative metrics such as book value, earnings power, and dividend history. However, Buffett did not merely adopt Graham's value investing doctrine wholesale. He refined it. While Graham sought cigar butt deals, companies trading well below their liquidation value but often lacking durable long-term prospects, Buffett evolved to seek businesses that not only were undervalued but also possessed sustainable competitive advantages. This distinction would become a hallmark of Buffett-style value investing, a marriage of Graham's discipline with a greater focus on quality. The concept of intrinsic value is particularly important. Graham defined it as the discounted value of the future cash flows a business can generate. This requires disciplined financial analysis and a willingness to resist the excitement of market trends. Buffett internalized this lesson, making it the foundation upon which his investment decisions rest. Price is what you pay. Value is what you get. Graham also introduced the idea of treating the stock market as an emotionally unstable business partner. Mr. Market, who offers daily to buy your stake or sell you more at wildly fluctuating prices. The successful investor, Graham taught, is one who takes advantage of Mr. Market's irrationality rather than being swept away by it. Buffett has consistently demonstrated this wisdom by capitalizing on market swings, buying when others fear, and holding steadfastly in the midst of hype. Another aspect of Graham's influence is the emphasis on self-reliance and intellectual independence. Graham's writings encourage investors to do their own homework, think independently, and not defer to the crowd. Buffett internalized this ethos, famously making most of his investing decisions from an Omaha office, far from the noise of Wall Street. Through the teachings of Benjamin Graham, Buffett learned to view investment as an exercise in rationality, discipline, and humility. This framework has served him throughout market booms and busts, providing a compass when others are lost in emotion or speculation. In summary, Benjamin Graham seeded the core principles of value investing in Warren Buffett's mind: discipline, margin of safety, a focus on intrinsic value, and the importance of independent thought. While Buffett would go on to add his unique flair and evolve the approach, the foundational aspects remain unchanged, a testament to the enduring power of Graham's philosophy and its central role in shaping one of history's greatest investment minds. Chapter 4. The Power of Patience, Waiting for the Right Pitch. Patience, often touted as a virtue, is the quiet force that underlies Warren Buffett's monumental success as an investor. In a marketplace consumed by haste and momentary trends, Buffett's steadfast willingness to wait for the right pitch has allowed him to achieve extraordinary outcomes where others falter. Understanding the power of patience is to appreciate the deliberate pace at which Buffett operates and the discipline that sets him apart. Buffett's revered analogy, investing as baseball without called strikes, is central to his philosophy. In baseball, a batter faces the pressure of an umpire's strike zone, forced to swing even at less than ideal pitches. In investing, however, there are no penalties for passing on opportunities. As Buffett explains, the stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch. This acceptance of inactivity is a defining difference between successful investors and unsuccessful speculators. The principle at work is simple. Superior results are achieved not by volume, but by selectivity. Buffett has patiently accumulated sizable positions in companies he understands and admires, often spending years studying an industry or firm before taking action. His investments, whether in Coca-Cola, American Express, or Apple, were not made in moments of inspiration, but after long periods of observation, analysis, and reflection. This patience ensures a deeper understanding of the business and entry at valuations that provide both safety and opportunity. This deliberate approach requires overcoming deeply ingrained human biases, especially the fear of missing out, FOMO, and impatience triggered by constant market movement. Investors are prone to worry when cash sits idly, to act out of boredom, or to believe that doing more must be better. Buffett's temperance is not passivity, but a conscious commitment to quality over activity. Buffett's storied career contains numerous instances where patience paid handsome rewards. In the 1970s, for example, rather than chasing glamorous technology stocks, he patiently waited for fundamentally sound businesses to become undervalued during bear markets. In 2008, while others panicked, Buffett's patience with holding significant cash reserves allowed him to deploy capital decisively when assets became deeply discounted. By resisting the urge to force investments, Buffett preserved his capital and positioned himself for outsized gains when opportunities finally arrived. Moreover, patience is closely tied to compounding. Investments in high-quality businesses benefit most when left undisturbed. The magic of compounding interest, as Buffett often describes, can only manifest over extended periods, decades in many cases. Selling prematurely, even for modest short-term gains, means forfeiting the exponential growth potential that underpins Buffett's long-term wealth accumulation. Patience also means accepting periods of inactivity or underperformance relative to market benchmarks. Buffett is unconcerned by the vicissitudes of the broader market, knowing that his process, not the short-term outcome, is the true measure of success. This quiet confidence is a product of discipline and experience, qualities he encourages all investors to develop. The power of patience extends beyond individual investments to the management of companies. Buffett selects managers who think in terms of years, not quarters. He discourages the pursuit of short-term results at the expense of long-term value creation, fostering a culture where rational decision-making and business durability take precedence. In summation, patience is not simply about waiting. It is an active, intentional choice to await the ideal circumstances before committing capital. It requires the courage to resist the crowd, the discipline to remain inactive until clear opportunities arise, and the self-confidence to endure temporary periods of inactivity or underperformance. For Buffett, patience is both a strategy and a shield, a tool for avoiding unnecessary losses and a pathway to extraordinary success. By mastering the art of waiting for the right pitch, investors can sidestep the pitfalls of haste, maximize the benefits of compounding, and seize rare but exceptional opportunities when they appear. In the world of investing, as Buffett demonstrates, the true measure of success is found not in speed, but in timing, and in the wisdom to know when to swing and when to stand still. Chapter 5, Circle of Competence. Knowing what you know. One of the most distinctive elements of Warren Buffett's investment strategy is his unwavering commitment to operating within what he calls his circle of competence. This concept, central to both risk management and effective decision-making, is deceptively simple in principle but profound in practice. It is all about self-awareness, knowing the boundaries of your understanding and having the discipline to stay within them. Buffett defines the circle of competence as the set of businesses, industries, or domains where an individual has deep knowledge and can make informed judgments. The size of the circle is not as important as the clarity of its boundaries. What counts for most people in investing, Buffett notes, is not how much they know, but rather how realistically they define what they don't know. Mistakes, he believes, are most often made when investors stray into unfamiliar territory, swayed by trends, pressure, or the allure of potential returns. The principle can be traced to Buffett's early investment style, which was shaped by Benjamin Graham's focus on what can be reasonably understood and assessed. Over the decades, Buffett has refined this philosophy, focusing only on businesses whose economics and management he truly comprehends. This has led him to avoid entire sectors, such as high-tech startups, biotechnology, and cryptocurrencies, where he feels he lacks a durable informational edge. Operating within one circle of competence yields several significant advantages. Firstly, it dramatically reduces the probability of error. When you understand how a business works, its revenue drivers, its competitive position, its risks, you are less likely to be blindsided by developments or succumb to unfounded optimism. This focus on knowability and predictability is a core buffer against catastrophic losses. Secondly, staying within your circle of competence cultivates a measure of humility. The financial world is replete with complex products and seductive narratives, but few people are skilled at passing all of them. Recognizing one's limits, whether personal or institutional, is an act of intellectual honesty, and it sets the foundation for prudent, rational decision-making. Buffett's own career is filled with examples of strict adherence to this principle. His investments tend to cluster in sectors with consistent earnings and established business models. Consumer goods, like Coca-Cola and Gillette, financial services, such as American Express and Wells Fargo, and insurance. These are areas where he has developed expertise over decades, allowing him to judge management, assess competitive advantages, and estimate future earnings with confidence. Importantly, Buffett does not view the circle of competence as fixed. Through study, experience, and measured risk-taking, it can expand over time. The critical rule, however, is to never act outside its boundaries until genuinely earned capability proves otherwise. Buffett's approach emphasizes deliberate learning and the slow, organic growth of expertise, rather than reckless experimentation. The circle of competence concept is also a powerful tool for everyday decision-making beyond investing. In business management, career planning, and even personal development, the discipline to focus on areas of strength and the humility to delegate or avoid what is not understood can lead to greater success and satisfaction. For investors, the lesson is straightforward but profound. Define your circle of competence honestly. Do not be tempted by the flavor of the month or the pressure to diversify for its own sake. The market offers endless opportunities, but only a fraction will fall squarely within your expertise. By concentrating your efforts and capital where you possess unique insight, you can build a record of success similar to that of Warren Buffett. In a world saturated with information and volatility, knowing your strengths and your limits remains a timeless competitive advantage. Buffett's unwavering commitment to his circle of competence serves as a model for all investors seeking to navigate complexity with confidence and clarity. Chapter 6. Investing in what you understand. Buffett's central doctrine in investing is deceptively simple. Invest only in businesses you understand. This principle, commonly referred to as staying within your circle of competence, forms the bedrock of his success. Yet while seemingly straightforward, it requires discipline, humility, and rigor. Understanding a business means grasping how it generates revenue, the industry dynamics, competitive advantages, risks, and long-term prospects. Buffett famously eschews investments in sectors outside his expertise, such as high-tech startups, preferring businesses with predictable earnings and proven business models. A deep understanding does not mean encyclopedic knowledge. Rather, it is a clear, confident grasp of the drivers behind profitability and sustainability. For Buffett, this means focusing on companies with transparent operations, consumer goods, insurance, banking, and utilities, among others. One must resist the lure of fashionable investments that promise astronomical returns but operate in opaque or volatile markets. Buffett's aversion to technology stocks until recent years exemplifies his commitment to understanding over-speculation. When questioned about missed opportunities in tech, he responded, "I don't invest in what I don't understand." To apply this principle, first delineate your circle of competence. Reflect on your professional background, personal interests, or academic knowledge. For instance, if you've spent years working in retail, you're likely to discern subtleties in consumer behavior or operational efficiency that outsiders might miss. Next, perform a rigorous examination of the businesses within your circle. Study annual reports, listen to earnings calls, and explore trade publications. Understand the business's competitive moat, an enduring advantage that protects against rivals. Buffett invests in companies like Coca-Cola and See's Candies not because they are the largest, but because they possess loyal customer bases, consistent cash flows, and branding power. Be wary of venturing outside your circle solely because of market enthusiasm. The tech bubble of the late 1990s or the housing craze in the mid-2000s seduced countless investors into arenas they didn't comprehend, leading to widespread loss. It is equally vital to distinguish between knowing and understanding. Many investors claim knowledge of a stock's price or news coverage, but lack insight into the core operation. Buffett cautions, risk comes from not knowing what you're doing. Ensure that any investment passes through the filter of true understanding. Finally, maintain intellectual honesty. Expanding your circle is possible, but gradual and deliberate. Learn from mistakes, study diligently, and recognize the limits of your expertise. As Buffett advises, it's better to be approximately right than precisely wrong. By investing in what you understand, you insulate yourself from undue risk, minimize speculation, and increase the odds of making sound, rational choices. The approach may seem slow or conservative compared to high-growth speculation, but as Buffett demonstrates, long-term wealth is built upon a foundation of deep knowledge, patience, and discipline. Chapter 7. The Art of Reading Financial Statements. Financial statements are the language of business. To Buffett, mastery of these documents is a non-negotiable skill for successful investing. In this chapter, we dive into the essential statements, income, balance sheet, and cash flow, and unravel Buffett's analytical approach. The income statement reveals a company's revenues, expenses, and profitability over a specific period. Buffett scrutinizes consistency in revenue growth and margins, prioritizing businesses that demonstrate reliable earnings. He looks for signs of durable competitive advantages expressed in superior profit margins or persistent revenue streams. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity. Buffett examines the strength of the balance sheet, favoring businesses with manageable debt, substantial cash reserves, and tangible assets. He pays close attention to ratios like current ratio, debt to equity, and working capital, seeking signals of financial resilience. Cash flow statements detail the money coming in and out of a business, emphasizing operational cash flow. Buffett values companies generating robust cash flows from operations, as it indicates healthy underlying business activity. He's wary of businesses reliant on financing or one-time asset sales to support earnings. Buffett's analysis doesn't stop at numbers. He explores footnotes, management discussion, and auditor remarks for insights into accounting practices, contingent liabilities, or strategic changes. He seeks transparency and honesty. Aggressive or opaque accounting practices are red flags. A hallmark of Buffett's approach is his focus on intrinsic value, the true worth of a business independent of market noise. By understanding the interplay between earnings, assets, and cash flows, he estimates the value of the entire enterprise and compares it to the market price. The greater the discount to intrinsic value, the better the opportunity, assuming the business quality remains high. Buffett applies the principle of margin of safety, discussed in the next chapter, to financial statement analysis, double-checking assumptions and erring on the side of caution. He avoids companies with volatile earnings, excessive leverage, or poor cash conversion. For the aspiring investor, learning to read financial statements requires practice and patience. Start by studying annual reports of businesses you know. Learn to reconstruct simplified financials. Pay attention to trends over time, not just single-year snapshots. Notice patterns in revenue, expenses, asset growth, and capital allocation. Don't be swayed by superficial presentations or market hype. Buffett's success stems from his relentless commitment to understanding the true condition of the business, not chasing flavor-of-the-month stocks. With diligence, you can cultivate the habit of deep financial analysis, uncovering hidden gems and avoiding costly misjudgments. Remember, financial statements are the X-ray of business reality. By mastering them, you transform investing from a speculative gamble into a reasoned, methodical process with far greater odds of long-term reward. Chapter 8. Margin of Safety. Protecting your downside. The concept of margin of safety is at the core of Warren Buffett's investment philosophy, inherited from his mentor, Benjamin Graham. It is the investor's primary shield against uncertainty and risk, a buffer zone established by purchasing assets at prices significantly below their intrinsic value. Finding the intrinsic value, the actual worth of a business based on its fundamentals, earnings power, and assets, is both art and science. Buffett estimates intrinsic value conservatively, accounting for potential errors, market volatility, and unforeseen events. The margin of safety requires that the purchase price is well below this estimated value, ensuring that even if circumstances deteriorate, the likelihood of permanent loss is minimized. This approach contrasts sharply with speculative investing, where the price may rise far above intrinsic value due to hype, emotion, or temporary market imbalances. Buffett warns that buyers of overpriced stocks or assets are like pilots flying with little fuel. The slightest turbulence spells disaster. To illustrate, consider a company whose calculated intrinsic value is $100 per share. Applying a margin of safety, Buffett might only consider purchasing if the stock trades at $70 or below. This 30% buffer compensates for errors in judgment, accounting irregularities, or market corrections. Buffett's preference for simple, understandable businesses enhances the margin of safety. Complexity increases the risk of misjudgment. The more predictable the cash flows and operations, the more reliably one can calculate value and safeguard downside risk. This principle also guides Buffett's avoidance of high debt. Companies with excessive leverage have little room for error. Downturns or misfortune can quickly escalate into insolvency. A strong balance sheet reinforces margin of safety, as does a history of stable earnings. Margin of safety extends beyond valuation. It informs portfolio management. Buffett concentrates on a small number of investments, where risk is thoroughly understood and controlled, rather than spreading capital across a wide array of uncertain bets. This focus enables deeper analysis and more confident allocation. For investors, applying a margin of safety involves patience, discipline, and a willingness to walk away from deals that don't meet criteria. It may mean waiting months or years for an opportunity. The reward, however, is the reduction of risk and the increase in long-term returns. In essence, the margin of safety transforms investing from speculation into prudent stewardship. It is the cornerstone of Buffett's resilience during market storms. He can withstand downturns because he has not overpaid or overleveraged. Let this principle guide your own investing. Calculate intrinsic value soberly, demand a genuine discount, and reinforce your positions with sustainable business models. As Buffett says, the first rule is not to lose. The second rule is not to forget the first rule. Margin of safety keeps these rules firmly in focus. Chapter 9. Compounding, the eighth wonder of the world. If one principle could be said to power the engine of Warren Buffett's wealth, it is compounding. Buffett has termed it the eighth wonder of the world, a phenomenon where returns build upon themselves, growing at an exponential rate over time. Compounding is deceptively simple in concept. The returns from investments generate further returns, creating a snowball effect. But the power of compounding only reveals itself with time and consistency. Buffett's decades-long commitment to reinvesting profits rather than extracting them is the secret behind his immense fortune. For compounding to work its magic, three elements must coexist: strong businesses with enduring profitability, patient reinvestment, and the avoidance of unnecessary withdrawals or taxes. Buffett's approach to selecting businesses is guided by a preference for those that can retain and reinvest capital at high rates of return year after year. A case in point is Buffett's investment in Coca-Cola. Berkshire Hathaway invested $1 billion in the late 1980s. By consistently compounding earnings and dividends, the position is now worth multiples of the original sum. It is not through rapid trading, but through patient holding that the compounding effect accelerates. The lesson is clear: frequent buying and selling, chasing hot trends, or withdrawing profits interrupts compounding and erodes returns. Buffett avoids unnecessary activity, opting instead for a buy-and-hold strategy where dividends and profits are continuously reinvested. Compounding also interacts with time. The longer the holding period, the greater the exponential growth. Buffett famously stated, "Our favorite holding period is forever." This philosophy encourages investors to think in decades, not quarters, and to tolerate short-term volatility in favor of long-term accumulation. Even modest annual returns, when compounded over lengthy periods, produce extraordinary outcomes. It is not necessary to pursue outsized gains. Consistency and patience suffice. Buffett's annualized return over more than half a century is a testament to the miracle of compounding. To harness compounding, choose investments with the capacity to maintain and grow earnings. Favor businesses with reinvestment opportunities, competitive moats, and stable management. Avoid high fees, frequent transactions, and taxable events that sap capital. Compounding extends beyond money. Buffett applies it to knowledge, reputation, and relationships, continually nurturing growth in all facets of life. The fruits of discipline, patience, and persistence are compounded over time, producing a legacy that rivals any monetary gain. Aspiring investors should savor the slow but unstoppable power of compounding. As you invest, resist the urge to micromanage or chase fleeting returns. Plant seeds in fertile ground, water them continuously, and let time amplify your efforts. Compounding, silent and relentless, creates wealth, monetary and otherwise, beyond imagination. Chapter 10. Avoiding Debt and Emotional Decisions. Buffett's aversion to debt is legendary. He has repeatedly warned that leverage magnifies risks and that even sound businesses can be undone by excessive borrowing. Debt introduces fixed obligations, interest payments, principal repayment, which must be met irrespective of business conditions. Buffett favors investments in cash-rich, low-debt companies. These firms can weather economic downturns, invest opportunistically, and avoid the destructive cycle of forced sales or bankruptcy. For individuals, debt restricts freedom, invites stress, and multiplies the consequences of error. Avoiding debt goes hand in hand with emotional discipline. The twin demons of greed and fear have ruined countless investors. During bull markets, greed seduces one into over-leveraging, chasing high returns with borrowed capital. In bear markets, fear triggers panic selling, locking in losses and destroying compounding. Buffett counsels calm, rational thinking. He avoids making decisions under pressure, whether buying, selling, or borrowing. The key to sound investing, he insists, is emotional stability. Recognize that markets fluctuate, maintain composure, and adhere to your principles. In practice, avoiding emotional decisions means creating and following a personal investment plan. Set clear criteria for purchases, sales, and asset allocation. Revisit these criteria during market turmoil, resisting the urge to react impulsively. Buffett's famous words, "Be fearful when others are greedy, and greedy when others are fearful," capture the essence of contrarian wisdom. Avoid speculation and the influence of crowd psychology. Popular trends often peak just as their risks reach intolerable levels. Buffett's investment in American Express after the salad oil scandal or in Goldman Sachs during the financial crisis exemplifies bravery in the face of widespread fear, grounded in rational analysis. Debt and emotion are interlinked. Borrowing amplifies the pain of loss and the urgency of decision-making. By conserving capital, avoiding leverage, and maintaining psychological balance, you safeguard both financial well-being and peace of mind. Aspiring investors must cultivate patience and humility. Accept that not every opportunity is worth pursuing and that occasional mistakes are inevitable. What matters is the discipline to avoid repeating errors, particularly those stemming from debt or emotion. Buffett's example demonstrates that financial independence is not only about maximizing returns. It requires careful stewardship, eschewing debt, mastering emotion, and forging a lasting partnership with well-chosen businesses. In so doing, investors build resilience against market storms and enjoy a life of simplicity, security, and fulfillment. Chapter 11. The Psychology of Money, Controlling Greed and Fear. Warren Buffett's enduring success is as much psychological as it is analytical. The most significant battles in investing are fought within the mind, against the impulses of greed and fear, and in favor of patience, discipline, and objectivity. Greed compels investors to chase high returns, succumb to euphoria, and overextend risk. Fear immobilizes, triggers panic selling, and blinds one to latent opportunity. Buffett's wisdom lies in his ability to detach from the emotional currents swirling through markets. Buffett recommends cultivating a temperament that is rational, measured, and independent. This involves setting clear investment principles and adhering to them regardless of external sentiment. The crowd oscillates between jubilation and despair, but the wise investor observes these swings and refrains from being swept away. He understands that markets are not perfectly efficient. Human psychology drives prices far above or below intrinsic value, creating opportunity for those who maintain mental clarity. Buffett's best investments have often come during periods of widespread pessimism, when prices are depressed and competitors are fearful. To achieve psychological mastery, one must recognize emotional triggers. The media, social circles, and market volatility all exert powerful influence, often leading to hurried or irrational acts. Instead of reacting immediately, Buffett advises pausing, reflecting, and evaluating the underlying facts. A further key to controlling greed and fear is adopting a long-term perspective. Investors focused solely on short-term results are prone to anxiety and overreaction. Buffett's horizon stretches over years and decades, enabling him to endure temporary setbacks and maintain confidence in sound decisions. Buffett also emphasizes the importance of process over outcome. He seeks to improve decision-making systems rather than focus solely on results, which are influenced by factors beyond control. This process-driven mindset insulates against disappointment and supports persistent growth. Descriptive analysis of Buffett's behavior reveals remarkable consistency in the face of adversity. Market crashes, economic crises, and dramatic news cycles have never dislodged his investment principles. He views volatility as a normal feature, not a cause for alarm. For readers, mastering the psychology of money means introspection and practice. Develop self-awareness regarding financial habits, emotional triggers, and investment rationale. Write down goals and principles. Review them regularly, especially when tempted to act impulsively. Buffett's teachings encourage us to see money not as a scorecard, but as a tool for enabling freedom, security, and meaningful contribution. By controlling greed and fear, investors chart a steady course toward both financial and personal well-being. The journey is as important as the destination. Chapter 12. Choosing the right businesses, not just stocks. A central tenet of Buffett's investment philosophy is the importance of investing in businesses, not merely stocks. This distinction may seem subtle, but it is profound in its impact on long-term success. Buffett considers stocks as partial ownership in real companies, with real products, employees, customers, and competitive dynamics. The lay investor often loses sight of this connection, treating stocks as lottery tickets. Buffett scrutinizes the business fundamentals: competitive moat, management quality, operational efficiency, brand strength, and sustainability. His investment in companies like Apple, American Express, and Coca-Cola is rooted not in market speculation but in unwavering belief in their business models and prospects. He seeks out firms with clear, understandable operations, resilient earnings, and strong growth potential. Buffett evaluates industry trends and competitive positioning. Companies operating in stable, essential sectors, insurance, food, utilities, are preferred over those reliant on technological disruption or regulatory changes. He asks whether the business will remain relevant 20 or 30 years hence. Management integrity is pivotal. Buffett interviews executives, reads press releases, and listens to earnings calls, searching for honesty, competence, and long-term orientation. He shuns companies with opaque governance, frequent strategic about-faces, or questionable ethics. Buffett also analyzes capital allocation. He favors businesses that reinvest profits wisely, fund growth organically, and avoid shareholder dilution or wasteful acquisitions. He looks for signs that management treats shareholders as true partners. For investors, the path is clear: shift focus from short-term price movements to long-term business viability. Select companies with proven track records, competitive advantages, and ethical leadership. The stock market may value or undervalue these businesses intermittently, but time ultimately rewards quality. Resist the urge to trade frenetically. Instead, treat your investments as if you were buying the entire business. Would you feel comfortable owning 100% of the company? If not, reconsider. Value investing rewards thorough analysis and enduring conviction. Buffett exemplifies that true wealth builds slowly but surely, rooted in ownership of businesses that compound returns over long periods. Such investments not only grow your portfolio, but also facilitate deeper knowledge and engagement with the world's most productive enterprises. Chapter 13: The Power of Reputation and Integrity. Reputation is the invisible asset that underpins every successful business and investor. Buffett devotes immense energy to fostering trust, fairness, and transparency in all dealings. He understands that reputation, once tarnished, is nearly impossible to regain, a principle he's woven into Berkshire Hathaway's corporate culture. Buffett cautions, "It takes 20 years to build a reputation and 5 minutes to ruin it." He demands the highest standards of integrity from himself, his managers, and his investments. This means honest communication, meticulous record-keeping, fair treatment of stakeholders, and scrupulous adherence to promises. Reputation amplifies competitive advantage. Customers, employees, and partners gravitate toward companies and leaders they trust. Buffett's investments in firms like Johnson & Johnson, Procter & Gamble, and American Express hinge on their legacy of reliability and ethical conduct. Integrity extends to financial reporting. Buffett shuns companies that obscure results, manipulate accounting, or mislead investors. He rewards clarity and candor even when results are disappointing. Trust can be tested in adversity. It is then, he believes, that true character emerges. For aspiring investors and professionals, reputation is cultivated by acting in good faith, keeping one's word, and owning mistakes. Buffett directs managers to ask, "Would I be happy if my actions appeared on the front page of my local newspaper?" This test curbs temptation and nurtures consistency. Reputation is critical in the investor's journey. It influences access to deals, partnerships, and information. An unblemished reputation acts as a compounding asset, opening doors that money alone cannot. Integrity, likewise, is non-negotiable. Rarely does Buffett trade it for short-term gain. Whether evaluating a business or a manager, he prizes character over credentials, long-term honesty over clever maneuvering. Let reputation and integrity be your compass. Maintain transparency in successes and failures, prioritize fairness, and hold yourself accountable. The rewards may not always appear on the balance sheet, but they are the bedrock of sustainable success. As Buffett's lifetime attests, true wealth consists not merely in financial accumulation, but in earning and preserving the trust of others. Chapter 14, Simple Living, Big Thinking, The Buffett Way of Life. Warren Buffett's reputation as one of the world's most successful investors is firmly established. Yet beneath the surface of his extraordinary achievements lies an equally profound and frequently overlooked way of living. To understand the true essence of Buffett's wisdom, it is vital to appreciate the singular convergence of simplicity and expansive thought that has defined his life. Buffett's home in Omaha, Nebraska, purchased in 1958, is emblematic of this philosophy. Despite his immense wealth, he has chosen to remain in the same house, eschewing opulence for comfort and familiarity. This decision, far from being an act of frugality alone, represents a deliberate alignment with his core values: clarity, modesty, and an unwavering focus on what truly matters. Buffett asserts that eliminating distractions and avoiding the trappings of luxury fortifies his ability to think deeply, remain disciplined, and invest wisely. Simplicity, for Buffett, is not mere minimalism. It is a strategic choice, an assertion that meaningful life and shrewd investing spring from purposeful living. By foregoing complicated financial structures and convoluted investments, he's able to concentrate his mental energies on understanding businesses, assessing their intrinsic worth, and making decisions based on timeless principles rather than fleeting trends. In his own words, the best investment you can make is in yourself. Such self-investment is best cultivated in environments that foster focus and deliberate thought. Divorced from the chaos of superfluous obligations, big thinking, too, is intrinsic to the Buffett way, an expansive vision powered by intellectual curiosity and an appetite for constant learning. Buffett has famously said he spends the majority of his day reading, a practice he regards less as leisure and more as preparation for sound judgment. His reading spans annual reports, newspapers, and biographies, each serving as fertile ground for synthesizing insights and recognizing patterns. Instead of relying upon external consultants or financial wizardry, Buffett embraces personal diligence. Trusting his analytical prowess, historical perspective, and logical reasoning, understanding Buffett's lifestyle and thought processes reveals a blueprint accessible to all, regardless of financial standing. It starts with intentional choices, maintaining manageable expenses, prioritizing education and self-reflection, and cultivating the discipline to avoid unnecessary risks. This simplicity breeds confidence, liberates mental capacity, and empowers individuals to think on a grand scale, unencumbered by the distractions so often heralded as markers of success. Perhaps most telling is Buffett's refusal to follow the herd. He operates independently, guided by principles rather than popular sentiment. This tendency, evident both in life and investing, is anchored in his confidence and humility, a marriage of traits rare in modern finance. By rejecting short-term emotional impulses and embracing patience, Buffett has demonstrated that enduring success arises not from haste or extravagance, but from steady, measured action rooted in wisdom. In adopting the Buffett way, one must first reconcile the superficial attractions of complexity with the tangible benefits of simplicity. Choose living arrangements, daily habits, and investment processes that foster understanding, authenticity, and rational decision-making. Pursue big thinking not for its own sake, but as a means of stretching beyond the comfortable and conventional, directing all intellectual efforts toward continuous improvement and long-term goals. Buffett's approach serves as an antidote to the noise of modern life. reminding us that clarity breeds opportunity, and simplicity is a force multiplier for disciplined thought. It is this intersection of simple living and big thinking that forms the foundation not only of Buffett's material success, but of his profound wisdom as a steward of purpose and prosperity. Chapter 15, Giving Back, the Philosophy of Generosity. At the heart of Warren Buffett's legacy lies not only the prowess of a brilliant investor, but the humility and compassion of a devoted philanthropist. His philosophy of generosity, grounded in both principle and practice, illuminates another facet of his enduring appeal and instructs us in the art of purposeful giving. Buffett's commitment to philanthropy began early but reached its apex with a transformative pledge in 2006. He announced plans to donate the vast majority of his wealth to charitable causes, primarily via the Bill and Melinda Gates Foundation. This monumental act reinforced the notion that with great wealth comes great responsibility, an ethos Buffett holds as central to his identity. Underpinning Buffett's philanthropy is the philosophy of compounding value, both in investing and giving. He recognizes that dollars entrusted to the most capable hands, those with expertise, accountability, and passion for impact, will escalate their effectiveness over time. Buffett's selection of charitable partners rests upon rigorous analysis akin to his investment practices. He identifies organizations with proven track records, robust management, and strategic vision, maximizing the societal return on his contributions. Buffett's generosity is deliberate, strategic, and governed by rational, not emotional imperatives. He avoids the temptation to scatter donations across a wide array of causes, preferring instead to focus intently on a select group of impactful initiatives. This concentration enhances effectiveness and accountability, echoing his approach in building Berkshire Hathaway: a few, well-chosen bets rather than innumerable, unfocused ones. Yet, Buffett's giving goes beyond financial gifts. He is a proponent of giving time and wisdom, mentoring young investors, engaging with communities, and lending his expertise to philanthropic boards. Buffett's annual letters, public lectures, and media engagements contribute to the democratization of financial knowledge, further expanding his legacy beyond the confines of monetary wealth. Central to Buffett's philosophy is the rejection of extravagance. He emphasizes that philanthropy must spring from genuine desire, not external pressure or expectation. For Buffett, giving is a private exercise rooted in personal conviction, not a public performance calculated for acclaim. His choices mirror this ethos: modest, consistent, and deeply intentional. Buffett is also an exemplar of stewardship, encouraging others in positions of influence to act as responsible trustees. The Giving Pledge, co-founded with Bill Gates, invites billionaires worldwide to commit half their fortunes to charity, igniting a global movement of collective responsibility. This, Buffett believes, is the true measure of success, not the accumulation of material riches, but the sustained commitment to bettering the world. For aspiring investors and leaders, Buffett's philosophy of generosity offers invaluable lessons. It is a call to prioritize impact over image and stewardship over self-interest. To think like Buffett is to recognize that the highest form of wealth is the ability to uplift others, leveraging resources, time, and talent for lasting societal benefit. In adopting Buffett's principles, one must cultivate self-awareness and clarity of purpose. Generosity should be authentic, thoughtful, and scalable, structured to endure and adapt in service of evolving needs. Look beyond immediate gratification and short-term applause, instead directing efforts toward incremental, compounding impact. Buffett's life demonstrates that generosity, much like wise investing, requires discipline, patience, and discernment. Through intentional giving, he has redefined the scope of legacy, urging all who follow to deploy their resources as forces for good, transforming wealth into meaning and success into significance. Chapter 16, Lessons from Berkshire Hathaway, the Rise of Berkshire Hathaway from a struggling textile manufacturer to a global conglomerate is emblematic of Warren Buffett's unmatched acumen as an investor and business leader. The company's story, stretching across decades of adaptation and ingenuity, serves as a masterclass in strategic thinking, disciplined execution, and the relentless pursuit of value. Buffett's transformative involvement with Berkshire Hathaway began in 1965 when he acquired a controlling interest in the fading textile firm. Initially intending to revitalize the business, he quickly realized that the textile operations were unsalvageable in the face of global competition. Rather than clinging to sunk costs, a trap that ensnares many investors, Buffett made the radical choice to repurpose Berkshire as a vehicle for broader investment endeavors. This decision, grounded in unemotional analysis and adaptive thinking, typifies Buffett's approach to capital allocation. Under Buffett's stewardship, Berkshire evolved into a holding company, acquiring businesses with enduring competitive advantages and exceptional management. The guiding principle was simple: invest in companies that do one thing exceptionally well, generating consistent cash flows and possessing the capacity for long-term growth. Acquisitions such as See's Candies, Jayco, and BNSF Railway showcase Buffett's preference for industries characterized by stability, resilience, and distinctiveness. Central to Berkshire Hathaway's success is the unwavering commitment to decentralized management. Buffett delegates operational autonomy to subsidiary leaders, offering strategic oversight while entrusting day-to-day decisions to those closest to the action. This structure fosters accountability, incentivizes excellence, and encourages a culture of entrepreneurship within Berkshire's extensive portfolio. It is a model that contrasts sharply with the micromanagement often seen in corporate America, a testament to Buffett's faith in people and process. Transparency marks another vital lesson. Buffett's annual letters to shareholders are renowned for their candor, depth, and humility. He openly discusses successes and failures, providing unvarnished insight into the company's operations, strategy, and philosophy. This culture of open communication builds trust with stakeholders and reinforces Berkshire's reputation for integrity, a trait increasingly rare in contemporary business. Long-term thinking permeates every decision at Berkshire. Buffett eschews short-term performance metrics and market speculation, favoring investments judged by their intrinsic value over time rather than temporary fluctuations. This patient approach has enabled Berkshire to weather market cycles, avoid panic-induced missteps, and achieve remarkable growth through compounding returns. Berkshire also exemplifies the power of adaptability. Buffett and his partner, Charlie Munger, have reshaped the company's investment strategy in response to macroeconomic trends, regulatory shifts, and emerging opportunities. Their willingness to evolve, experiment, and when necessary, pivot is instructive for all who seek enduring success in business and investing. Berkshire Hathaway's journey underscores several key principles. Prioritize substance over style. Invest in people as much as products. Communicate with transparency and never sacrifice the long-term for short-term gain. It is a vivid illustration of Buffett's central philosophy that greatness is built not in bursts of brilliance, but in steady incremental progress driven by discipline and vision. For readers aspiring to emulate Buffett's methods, Berkshire's lessons are clear. Seek businesses with fundamental strengths, nurture talent, maintain transparency, and always think in decades, not quarters. In doing so, one can build not only financial success, but organizational resilience and a legacy of trust. Chapter 17, Mistakes, Failures, and What They Teach. The arc of Warren Buffett's career, while defined by exceptional triumphs, is equally punctuated by mistakes and failures, episodes that serve as crucibles for growth and transformation. To truly think like Buffett, one must embrace these setbacks as invaluable teachers, sources of insight where ego and judgment are scrutinized. Buffett is candid about his errors, often discussing them in his annual letters and interviews. He acknowledges, for example, his early investment blunders, such as purchasing Berkshire Hathaway itself for sentimental rather than rational reasons, ultimately costing him millions and motivating him to adopt a more disciplined approach to capital allocation. This willingness to admit and learn from mistakes reveals a vital lesson. Humility is the cornerstone of sustained success. Buffett's failures are not concealed behind rhetoric or denial. Rather, they are analyzed systematically to extract lessons. When Berkshire acquired Dexter Shoe Company, a deal made in exchange for valuable stock and later proved disastrous, Buffett reflected not with regret, but constructive self-critique. "I will make more mistakes," he wrote, "but I will try to make different." And the ability to draw unique insights from each misstep is central to Buffett's ongoing improvement. One of the most enduring principles gleaned from his failures is the importance of avoiding what he terms the institutional imperative. This refers to the tendency of individuals and organizations to follow established patterns or imitate others, even when contrary evidence suggests otherwise. Buffett's experience has taught him to remain vigilant against herd mentality, seeking independent verification for every significant decision. Patience is another lesson fueled by adversity. Buffett often recounts missed opportunities, companies he could have acquired cheaply, investments he overlooked, but he counsels against frustration and impulsivity. Instead, he advocates for preparedness, to wait, study, and strike only when conditions are optimal. This meritocratic patience ensures that losses, rather than being demoralizing, act as springboards for superior outcomes. Transparency in failure also matters deeply. Buffett's forthrightness builds trust within Berkshire Hathaway, reassuring employees and shareholders that risk is managed with honesty and accountability. Such openness diminishes the stigma attached to failure, encouraging a culture where lessons are shared rather than buried. Moreover, Buffett leverages his setbacks to refine his analytical frameworks. He develops checklists to avoid repeat errors, strengthens his valuation models, and revises his investment criteria, demonstrating his belief that perfection is unattainable, but progress is imperative. For readers, these habits articulate a blueprint for resilience: analyze, absorb, and adapt. Perhaps most importantly, Buffett's attitude toward failure is rooted in optimism. He views mistakes not as permanent stains, but as necessary elements in a tapestry of innovation and renewal. By consistently converting adversity into wisdom, Buffett exemplifies the art of lifelong learning, a quality indispensable for sustained prosperity. In the pursuit of Buffett's way, individuals must welcome failure with courage, treat it as formative, and integrate its lessons with humility. In doing so, every setback becomes a source of strength, a step nearer to fulfilling one's highest potential in both investing and life. Chapter 18: Buffett's timeless advice for young investors. Warren Buffett's influence as a mentor and educator is perhaps most pronounced in his relationship with young investors. His empathetic guidance, distilled from decades of experience, offers a beacon for those navigating the early stages of wealth creation and personal development. Buffett's first counsel is unequivocal: develop yourself. He urges young investors to prioritize education, self-awareness, and integrity above all. This foundation is crucial for sound financial decision-making, but also for forging a resilient character capable of withstanding market volatility and personal challenges. Reading widely, thinking critically, and learning continuously are habits Buffett commends, cultivating not just financial acumen, but wisdom in daily living. Secondly, Buffett advocates for frugality and discipline in money management. He reminds young investors that wealth is built incrementally, choosing to save, invest prudently, and avoid unnecessary debt. Buffett's own life is a testament to the power of compounding interest. He began investing as a teenager, allowing his modest initial capital to grow exponentially over time. He counsels patience, warning against the allure of quick returns and high-risk speculation. Value investing, the core of Buffett's strategy, is a skill he encourages all to acquire. This approach requires evaluating companies on their intrinsic worth rather than market hype, ensuring investments align with long-term prospects rather than short-term profits. Buffett advises seeking businesses with sustainable advantages, strong management, and proven profitability. He cautions against following trends or succumbing to emotional impulses, advocating rational analysis and independent thought. Buffett also imparts the importance of ethics in every transaction. Honesty, he argues, is the bedrock of reputation, a currency far more valuable than money. Young investors are urged to conduct themselves with transparency, fairness, and respect, fostering relationships that endure and trust that compounds. Diversification is addressed with nuance. Buffett often recommends focusing investments within one circle of competence, acquiring intimate knowledge of a few industries rather than spreading resources thinly across many. This concentration, paired with rigorous research, enhances the probability of meaningful success. Buffett's advice extends to lifestyle choices as well. He encourages simplicity and moderation, reminding young people not to equate happiness with material excess. Building a life around purpose, relationships, and generosity provides a more enduring foundation than the pursuit of luxury or status. Finally, Buffett challenges young investors to remain open to failure and change. He advocates for adaptability, continuous learning, and the cultivation of long-term vision. His own career is marked by pivots and recalibrations, each undertaken with humility and resolve. Aspiring investors who heed Buffett's timeless advice will discover that success is not a destination, but an ongoing process, a series of deliberate choices, measured risks, and principled actions. Through discipline, patience, and integrity, one can build prosperity both material and meaningful, forging a legacy to inspire generations. Chapter 19. The Future of Value Investing in a Changing World. Value investing, as championed by Warren Buffett, has long served as a bulwark against speculation and volatility. Yet in the contemporary landscape, characterized by technological disruption, global interconnectedness, and evolving economic norms, the future of value investing demands both a reaffirmation of its core principles and a willingness to adapt. At the foundation of value investing lies the search for intrinsic worth. Investors seek companies trading below their true potential, measured through careful analysis of assets, earnings, and market position. In an era where information is ubiquitous and markets respond instantly to news, the challenge grows. Today's investor must navigate not only financial statements, but also data analytics, competitive intelligence, and macroeconomic trends. Buffett contends that technology can be both friend and foe. While algorithms and automated trading threaten to erode the slow, thoughtful approach of value investing, they also offer unparalleled tools for research and modeling. The key, Buffett suggests, is to remain grounded in principles, rejecting hype, eschewing market sentiment, and trusting empirical evidence. He urges investors to study industries intimately, cultivate patience, and avoid impulsive reactions to transient events. The globalization of capital markets further complicates value investing. Opportunities abound in emerging economies, yet so do risks: political instability, currency fluctuation, and regulatory variance. Buffett advises adapting frameworks to account for these dynamics, balancing expansion with caution, and always privileging stewardship and sustainability. Buffett's embrace of technology companies, such as Apple, marks a shift from traditional value investing toward greater openness and agility. He recognizes that moats, sustainable competitive advantages, now often depend on intangible assets like software, intellectual property, and brand strength. Investors must therefore refine their evaluation criteria, integrating qualitative factors with quantitative analysis, and continually questioning assumptions. Environmental, social, and governance (ESG) considerations now play a vital role in investment decision-making. Buffett acknowledges that enduring value resides in ethical leadership, environmental responsibility, and social contribution. He encourages investors to assess companies holistically, understanding that reputation and stakeholder trust increasingly drive financial performance. Market cycles remain inevitable. Buffett warns against attempting to time markets or predict trends. Instead, he champions resilience, constructing portfolios that weather storms and thrive in various conditions. Long-term orientation, diversification within core competencies, and attentiveness to systemic risk are essential safeguards. The future of value investing, as Buffett foresees, is anchored in wisdom, adaptability, and robust methodology. Investors must synthesize tradition with innovation, prioritize integrity, and consistently refine their strategies. In doing so, they will not only preserve Buffett's cherished legacy, but also discover new avenues for prosperity in a changing world. Chapter 20. Thinking like Buffett. A life of purpose, patience, and prosperity. To think like Warren Buffett is to engage in a lifelong journey of purpose, patience, and prosperity. These pillars, interwoven throughout his career and personal ethos, have guided every decision, fostering not only material success, but profound fulfillment. Purpose is the lodestar of Buffett's philosophy. He views investing and life as interconnected ventures, each demanding clarity of intention and commitment to principle. Buffett chooses investments based not on fleeting profit, but on enduring impact, favoring companies that contribute meaningfully to society, possess ethical leadership, and demonstrate resilience. In life, he advocates selecting pursuits aligned with passion, curiosity, and service, resisting the lure of popular acclaim in favor of authentic satisfaction. Patience is arguably Buffett's greatest virtue. He teaches that progress is incremental. Compounding interest, steady learning, and measured choices forge unassailable advantage over time. Impulsivity and haste, conversely, are pitfalls that destroy potential. Buffett's patient approach is evident in his investment horizon, often stretching decades, as well as his handling of setbacks. He counsels individuals to prepare diligently, act judiciously, and await the fruits of disciplined labor, believing that enduring prosperity must be earned, not seized. Prosperity for Buffett transcends monetary gain. It encapsulates well-being, relationships, and legacy. He measures success in terms of integrity, contribution, and the happiness derived from purposeful living and giving. Buffett's own modest lifestyle, unwavering generosity, and tireless mentoring exemplify a prosperity accessible to all, one built on gratitude, stewardship, and the empowerment of others. Buffett's mental models, born of critical thinking, probabilistic reasoning, and historical perspective, equip individuals to navigate uncertainty and optimize decisions. He encourages rigorous analysis, certainty of process, and humility in judgment. Independent thought and logical risk assessment form the bedrock of his approach, guiding choices both grand and minute. For those seeking to emulate Buffett, the challenge lies not in mimicry, but in cultivating the qualities that define his genius. Develop your own circle of competence, invest in personal growth, and hold steadfast to enduring values. In adversity, seek wisdom. In success, practice generosity. Maintain simplicity, nurture curiosity, and let purpose guide all pursuits. If you found this video helpful, inspiring, or entertaining, don't forget to hit that like button. And if you're new here, make sure to subscribe and turn on the notification bell so you never miss out on future content. Your support means the world. Let me know your thoughts in the comments below.